Welcome everybody back to the Today's Market Explained podcast. And today, this is an interview version. As most of our folks know, we do market commentaries as well, but then we like to interview and talk with key players in the economic world, and that relates to areas of emphasis and concern sometimes as well in the economic world. And right now, there's a lot of concern about a lot of things. So we are going to talk about lending, the mortgage industry, interest rates, and we have a really interesting character here to join us today. His name is Shashank Shekhar, founder and CEO of InstaMortgage. Welcome, Shashank, to the 4-star Today's Market Explained podcast.
Thank you, Brian. Glad to be here.
So we talked earlier about your first name, and it's not Shashank, like the Redemption, but it's Shashank, right?
Yeah, so it's kind of a take. There's no W in there like Shawshank is. It's just
Right.
Shashank. But it's still interesting. I mean, coming to a place where I'm from India, just for the audience, just for that background, and coming to a place where it could be hard for people to pronounce your name. I found an able ally in Shashank Redemption movies because I could always reference to. It's just like the movie without the W. So it is it's a fun and interesting take, so to say.
So everything in America has to be made easy for people, right? So
Yes, exactly.
yourself a Shashank guy.
Yes, there
That's
you go.
good. Well, Shashank, welcome again to the podcast, and
Thanks.
And we have a lot to talk about, and one of the big issues is your whole industry and how things have developed. But tell us, you're from India originally, and a state called the Bihar, which is in the north,
Yes.
adjacent to Punjab and Andhra Pradesh and some of the others up there, I believe. And so how did you develop this business, and then you moved from India to here? Tell us that whole evolution.
Yeah, sure. I was born and raised in a very small village in India, and some people might be surprised that we had no electricity, we had no running water, we had no paved roads. In my school, we used to sit on the floor because the chair was reserved only for the teachers. So,
Right.
so that's how it started. My mother was a primary school teacher, and very soon she thought I was too smart for village school. And as my luck would have it, my aunt was willing to take me to one of the big towns called Calcutta, which is one of the biggest metros actually in the world, not just in India. And so I went to study there, and eventually went to one of the best business schools in India, majored in marketing, worked for General Electric, which we all know is one of the biggest employers in the world, and then moved to a very small companies because I always wanted to start my own company and wanted to learn from people who are building business from scratch. So I go from this huge company called General Electric to this very small company where I was employee number 2. So it was a brand new startup, and they were doing some stuff on the US mortgage space, but I was still in India. So that's how I moved working to that company. They eventually moved me to San Francisco Bay Area here in the US as the head of business. And then just about 16 months into the new country and the new role here in the US, 2008 happened and everything collapsed, as we know, not just within say the US marketplace, but overall financial services and global marketplace took a beating. And that's how the company, which was then VC funded, lost all the funding, shut down its shop. And I was left in a new country with a very young child, $1,900 in savings, and practically zero connections. I literally knew, Brian, 3 people in the entire country back then. And those were the 3 people who just lost the job along with me. But the only thing that I knew, 2 things really. One is that I really wanted to start something. That's why I had moved to a smaller company compared to a very successful General Electric stint that I had before. And 2, I knew a little bit about mortgages, because that's what we were doing in the company that just shut down. So I was like, okay, I want to do something on my own. I know a little bit about US mortgages. So what if I have $1,900 in savings and I live in a rented apartment and I really have this small child to take care of? Let me be this entrepreneur that I always wanted to be. So I took a shot at it and very quickly realized that was a very stupid shot, that I should not have taken it, that I should have played it safe and just gone. And
so you knew nobody, you had $1,900 to your name. You started a company in the middle of the worst recession besides the Depression in America. And sounds good to me.
Yeah, perfect plan. And mortgage was the dirtiest word on the planet, as you know, because everybody was blaming mortgages for all of this. So everybody would buy. So exactly. So that's how it started. So of course we are sitting here, so it must have gone okay since then. But what I'm trying to say with all of that is it's something that hopefully some of us can learn is that in financial services business, some of your advisors, I mean, they're technically CEOs. They run their business on their own. A lot of people post their business on their own. Just like mortgages, a lot of us own their business on their own. This is even if you work for an organization, you're essentially a CEO of your organization. And so to do that in those tough times was, even though it was probably more brave than wise, but it also teaches you on kind of baptism by fire, right? It teaches you how to grow up very quickly, how to learn from all that chaos that you are in. And then when things go wrong down the road, then you're like, this is not as bad as it was in 2008. So to say, from a framework perspective, is that's the kind of framework that you have. And so that's actually, so in a sense, if I look back at it, I mean, it actually worked out pretty well, even though the initial struggle was quite real, of course, given all the challenges.
Well, yeah, very interesting. So what was it? How did you offer mortgages during that period of time? Were there any real estate transactions? Or didn't real estate transactions go down 80% from the top? I mean, so
yeah, it did. Yeah, no one was really buying and refinancing. 65% of the people within the industry were leaving the industry. So that's what was the final number, is that say if there were 100 people within the mortgage space, only 35 remained at the end of 2009, 2010. So most people had left the business by then. And I was getting into the business. Right. But really, you're right. I mean, the first 12 months, I did 7 transactions. That's like half a loan a month, so to say. Last year, as a reference, again, I did over 700. So that tells you the kind of transition that I've had from then until now. But no one was buying or refinancing. And even if they were, I mean, I had no connections. Usually when you get in a business like financial planning or mortgages or real estate, the first people that you talk to are people what are called within your sphere of influence, right? You go to your high school friends, you go to your neighbors, you go to your college friends, you go to your in-laws, you go to those people and say, hey, I'm in this business. Give me some business. Please refer me anybody that you might know. In my case, that wasn't a luxury because, as I said, I didn't know anyone in the entire country. I was very new to the country itself. So I took a step which was very different than most people, how they were working the business. I really focused on education as a platform. So I started blogging in 2009 when less than 10 people in the industry were blogging. And so for me, it helped in 2 ways. One is that I always wanted to build a business on the platform of education, because when you're in a business like a mortgage or even say financial planning, for example, education is huge. Is because it's so complicated, so convoluted. It's something that people don't understand. And that's what my value add to them was. Look, I'm going to provide you education. I'm going to provide you value even before you choose me as your lender. And so that's why. And the second trend that I was noticing is that most of the people were consuming news online starting 2009, 2008. So I was seeing a trend shifting from television and print media to more online media. And so even though I wasn't really good at writing to begin with, that's a platform that I chose and that I decided to educate clients. And it took, again, nothing happens overnight, as we all know. I remember blogging twice every week for 6 months straight. And then eventually somebody called me after 6 months saying that they saw my blog online. So imagine doing something, spending 2-3 hours every week for 6 months and nobody's noticing it. And you're like, is this thing even working? Hello, it's someone's there. And nobody's there for a very, very long period of time. And then someone calls you saying they saw you. So things started changing after that. But yeah, it was a lot of struggle trying things which were not in practice, then getting hugely out of comfort in terms from your comfort zone perspective, and trying out things which, nobody was really trying and failing at it miserably to begin with.
Well, a couple thoughts on all this. They always say in the financial advisory industry that if you're going to succeed, start in a bear market, because if you can make it, then you can make it anytime.
Exactly.
Mortgage business, that's what you did.
Yes.
In the worst possible mortgage market you could get, and you still figured it out.
Yeah.
Still, congratulations.
Thank you.
The other comment I had about what you said is you mentioned focusing on the educational market. Many of the listeners know, but not all of them know that my wife is Asian Indian and born from the Gujarat state, but born in Maharashtra, which is the state where Bombay is.
Yes.
And her family and the whole Indian culture, as I've come to know, is very much education based.
Yep.
And so if the best thing you can value is what you know and your knowledge. So it's all about college and making sure everybody goes really formal schools, does really good training, gets good skills. And so you use that to your advantage then, Shashank.
I did, yes, of course. So you basically, when you have your backs against the wall, then what you need to be looking at is what are the skills that you bring to the table which makes you different. So I dug into some of my marketing experience from my business school, understanding where the consumer trends were shifting, and then building on my education background, so to say, and trying to see what is it that the customers need right now. So you were basically trying to combine your the skills that's essential, but also going back to some of the things that you have been taught and bring those two things together to figure out what will work. And thankfully it did. Again, it did not work overnight, but eventually did.
Excellent. So tell us how you launched. Like, how did it what finally started to work then? Did you start to write mortgages? Did you advise on mortgages? What was the initial growth where the revenue started coming in?
Yeah, so it was mostly in the beginning, it was a very basic model of just trying to originate mortgages. This was a very small company. We're just brokering out. We did not have the staff to underwrite mortgages or fund mortgages on our own. It's still 12 months down the road, I hired my first employees. We were still two people, even when we were starting to get about 2-3 loans. From half a loan to 2-3 loan was quite an upgrade, so to say. At least I could pay my bills at that point of time, and have this another employee to help me out with a few things. Right. And so that's how it started. I remember, I think from 7 loans in the first year, I did about 26 in year 2, and I think that ramped to about 72 in year 3. So slowly people started noticing. So there were 2 things that you need to do, or I did, is that you need to figure out how do you get people into the door, and then once they are inside your door, then what do you need to do for you to be able for them to keep coming back or having good words about you. So really, I try to simplify this business model, which seemed very complicated to me in the first 12 months because I was failing miserably at it. I could not figure out how to get clients. And so I try to simplify it, saying, what are the biggest challenges? Like, what are my 2 or 3 biggest tasks that I have to do? And I took this huge business where people will do 3 days of conferences to teach you what to do and what not to do and all of that stuff. And I broke it down into the fact that really you're only solving 3 problems, which is, how do you get more leads? Meaning, how do you get more people to call you or email you or come to you? How do you convert those leads? Meaning, once they come to you, then how do you close them? And how do you make sure that they work with you and not somebody else? And how do you get those converted leads to keep coming back for more? Really, those are the 3 big problems that you're trying to solve. And so I simplified it at a very, very simple level. Is that, okay, now that I know that I have to fix these 3 problems, let me handle one at a time. And which is like, how do you get more leads? So blogging was my way, for example, to do that. And I added more arsenal to that. I started speaking. I started then doing events for real estate agents and financial planners and CPAs so that I can give more value to them in terms of where the market was, where it was going, and so they would refer me business. And then once they came in, is that what kind of customer service do you provide so that they don't go somewhere else and stay with you? That's solving the second problem. And third was purely database management, is that even though, again, I did not have super heavy tech to work off, I was just working on my Excel and so very basic technology, so to say. But how do you stay in touch? So sending birthday cards, calling them, texting them, sending them of something of value. And so they kept coming back for more, and they started referring some of the clients.
Basic customer service, right?
Yeah, I mean, it's a very simple business model, so to say, but you'll be surprised that 98% of the people at least in my industry. I mean, I do keynote speeches at most major conferences across the country, and you'll be surprised how people in the business 20, 25 years still struggle, is because these three simple problems to solve with apparently easy solution, apparently simple solution. I should not call it easy because it does require a lot of discipline and work and everything else, but apparently simple solutions, people just are not able to do it.
Yes, and it's interesting. At the beginning, you said you found so many things that didn't work, but from the perspective of an entrepreneur, you found successfully dozens of ways that didn't work on your way to finding out what did work.
Exactly. I actually wrote an article for Inc. magazine, how to reframe your failure, or 4 steps to learn from failure. One of the things is exactly what you just said. What Thomas Edison says, that I've figured out 1,000 ways in which it won't work. Not 1,000 ways in which I failed. So he basically reframed his failure when he was working on the light bulb, is to say, I've figured out 1,000 ways it won't work, knowing that in a way saying that I'm getting closer to success or closer to figuring out a way it will. So every single thing that does not work is basically one less thing to work down the road. Now you're hopefully narrowing down your success path.
So that's great stuff. So you developed the business, and then it started to work. You started hiring people, building a company, and you mentioned Inc. magazine. Then you were actually recognized by Inc., weren't you?
Yeah, twice. In 2017, for the first time, we were named one of the fastest growing private companies in America. We ranked, I think, 410, 411. And if you, just to give some context to the audience here, Brian, there are about 6 million private companies in the US. So to be named in the top 400, we were in the top 500 in the fastest growing. That's, I mean, if you thought Stanford and Harvard's acceptance rate at 5% is low, I mean, we are talking 0.001 or something to be named top 500 out of 6 million companies. So it was extremely gratifying for the work that we were doing, extremely rewarding, because that was the first major award. And that too, it was, they call it the most exclusive club in businesses, because it's not easy to keep that kind of growth rate over 3 years and be named in the top 500. So it just kind of, it gives you that boost to keep doing this more and more, because at some point of time, of course, it could get tiring and it could get, it's a very hard work, but Inc. magazine recognized us for that. And that was a big boost, because that really actually put us into a different level of growth since then. And we have grown even faster since the first award that came in.
That's great. And so that really helped propel you too, as well.
Yes, it puts you in kind of a more of a spotlight. It gives you something to talk about when you're talking to potential hires, when you're talking to potential partners, everybody else, is because they see you as playing this big field. I mean, an award like that kind of really gives you more credibility to what you're doing. You are not just talking what you're saying. There is somebody else who backs that up, because they verify all your numbers and everything else. So in the last 3 years, again, in fact, we have grown so much that we came back to win the Inc. 500, this time ranking even better than the last time, in the top 400 instead of the top 500. And then we were the only mortgage company last year to be named to the Deloitte Fast Tech 500, which is a list which only the tech companies are actually entertained into. It's because there's a technology award, and a mortgage company has never won the Deloitte Fast Tech 500. And not just we won that award, or we were named to that award, we actually ranked higher than companies like Zoom and Pinterest and Esquire, which we all know is way more household names and 100x bigger than our name. But we ranked 110 on that list, and those companies actually ranked lower than us, which means we grew faster than Zoom in a pandemic year. I mean, beat that. So
amazing. Well, then you've taken some of your success as well and developed an author series as well. You're an author.
I am. So yeah, to begin with, as I said, I started writing blog, which was one article at a time, and really sucked at it. I mean, some of the initial blog posts were very cringy. I've kept it there just so I can show my kids that you can be this bad a writer. It is possible.
Still succeed.
Yes. So it keeps you grounded on bad days of writing, that you were this bad. So you can't go back to being this bad. But so I've not been a natural writer, is what I'm trying to say. Also, kind of trying to tell the audience here is that you don't have to be naturally good at something. I was not naturally good at writing. I was not naturally good at speaking. So all of these skills require work. I mean, even if you went to school or college or somebody taught you a course on something, at the end of the day, you still have to practice in the real world. And so you will struggle at it in the beginning, whichever skill you are trying to, or just being good at financial planning, for example. I mean, whatever you're trying to be good at, there's a reason there's that 10,000 hours rule, is because you need to keep putting into the effort, into the skill. So yeah, I mean, initially I started blogging, but then I realized that there was no one place where people who are thinking of buying their first home could read cover to cover everything that they needed to do. So I wrote my first book, was kind of okay. And then I wrote a book for the real estate industry, Real Estate Unleashed. So that was meant for people who are within the space, kind of trying to teach them that the world has changed and it was more a marketing playbook on how to win in the new world of real estate. And then my first home came out, I think about 3 years back, and instantly made it to the #1 bestseller list on Amazon, and went on to win several awards at New York Book Festival in San Francisco and several other book festivals. And so that has been my author journey, working on a new book for entrepreneurs about how to build a fast growth company, because that's what we have built here at InstaMortgage, and trying to take some of those learnings and putting that into a book, which hopefully should be out next year. My editor has been asking that same question for the last 12 months. So when is it coming out? So we'll see when it actually does.
Well, great. Well, it's all wonderful. So fast forward to today. You're in the mortgage business. What kind of mortgages does InstaMortgage work with?
So we work with residential mortgages primarily. That's what 95% of our business is. We do offer commercial mortgages as well, but most of our clients are people who are buying or refinancing residential homes across the country. We are licensed in 26 states, which 26 states account for almost 3/4 of all mortgages done in the US. So even though geographically speaking, it's about half the country, from a mortgage production, it's almost 75-80% of total production in the US. And we do all possible programs within the residential space. So anyone who's looking to buying or refinancing, whether they're looking for conventional mortgages or FHA or what is called non-qualified mortgages or big loan, we go up to about $15 million in loan sizes. So practically any kind of loan that you're looking for from a residential mortgage perspective is what we provide.
Nice. And so what is the state of play in the mortgage industry? Rates are rising now. We've heard purchase contracts have slowed down dramatically, somewhat sharply. Things look a little scary out there. What do you think?
It is. I was actually doing a company meeting just before this, and I had like a 10-minute talk just on the state of where the businesses are, and somebody commented it sounds like 2008 all over again. So it's and it is. It's probably not as bad as 2008 was, but there doesn't a day go by before you don't hear about some kind of layoffs or some company closing down. And we are not talking tiny companies with 5 people. I mean, just the other day, the 2 companies that closed down, one had 500 employees, the other has 700 employees. The largest fintech within the mortgage space with over $1 billion in funding. They have had 3 rounds of laying off more than 50% of their employees. The likes of JP Morgan's and Wells Fargo's of the world have laid off almost half of their mortgage employees. So we are talking a very difficult year, because usually, we all know that the rates went up the sharpest that it has ever been in the history of mankind, not mankind, but at least within the US industry, US mortgage industry. And because of that, I think it's just that nobody could plan for it. And you can't blame the industry, because really nobody saw it coming. None of us really thought that the rates will climb so high and so quickly. And that threw a lot of the plans in this manner. And so you had refinance, of course, going away completely, which was expected some point during the year that that's going to happen. But the double whammy was that when the refinance went away, you thought you could get some purchase business. But initially, the inventory was too low. There were just not enough homes to sell. And now that the inventory is coming back, because the rates are so high, the borrowers are, or the potential home buyers are not too bullish about buying homes. Also, because a lot of their saving, which was either in 401k or stocks, have kind of evaporated because of the fact that we are in the bear market in the stock market. So, and then you have sentiments around inflation, high cost, everything else. And home buying is also a lot of it got to do with emotions, not just a financial decision. And when you see everything around you, economically and financially speaking, not really working out well, sometimes you're like, let's just stay as is. I mean, why change things when we don't know where the future, what the future lies?
So that's how people feel now, you think?
Yeah.
So what will happen from here? Is it? Well, let me ask you this: Is it year over year as bad a fall as 2008? You say it wasn't quite as bad, or?
It actually is. So 2008, if you look at the year over year, it's actually a worse fall than 2008. The reason being is that 2021, 2020 and 2021 were the two of the biggest year for mortgages in the history. We crossed $4 trillion of production each in 2020 and 2021. And the highest we have ever done was, I think, 3.2, 3.3. So we did not just cross the last one by a distance, we did it back-to-back years. And so we staffed for that. We added all the cost for that. And when I say we mean as an industry, when you are staffed for a production that's almost 200% higher than your last production, and then you drop 50, 60, 70, 80%, I mean, within a matter of 3 months, then it's a kind of a landscape which is very difficult to traverse, right? You go from here to here, and then you have to suddenly drop here. It's very difficult to pilot something like that. And that's where the big challenge is that. And that's why the drop is bigger than 2008, is because from 07 to 8, the drop wasn't as big as it's from the last 2 years to this year.
So, but rates are still rising. Is that right?
Rates. So I was interviewed for Time.com about 6 weeks back, and I had then predicted that I think we are stabilizing on the mortgage rates, and even though on a day or a weekly basis we might see the rates go up or down, that over a period of time I think it should stay stable, and we have been pretty stable over the last 6-8 weeks. Again, we have seen some weeks where the rates have gone up and some other where it's gone down, and my feeling is that we are probably at a more stable level now, but we have stabilized at a rate which is double than what it was just 6, 7, 8 months back. So stabilizing is a good thing, because constantly rising rate environment sends even more of a bad, say, feeling, so to say, among home buyers, is because just last week they got pre-approved at a certain rate. 2 weeks later, by the time they get into contract, the rates are much higher. Yeah. But so at least rate stabilizing, what it does is that after a point of time, when if you're thinking of buying a home, you are like, it is what it is. When you get the initial shock, if the S&P drops, I don't know, to 3,700, initially it's a huge shock. But if it stays at 3,700 for next 6 months, you're like, it is what it is. That's what the stock price is. Do we want to buy or sell, whatever? So I think that's what will happen within the mortgage space as well, is that once people realize that we are in the 5% range territory and no longer in the 2s and 3s, then it is what it is. Do I want to buy a home at this rate or not? Right.
So is it your sense that once everyone settles down, eventually activity will begin again?
That's what my sense is, that the inventory is definitely up, is because sellers are trying to get in before things worsen. And that's what it does, is that the markets, that's the thing about real estate, is that the market moves so quickly, is that it just gives you no notice at all. I mean, just about 8 weeks back, it was a seller's market. Now you're in the buyer's market in most of the markets in the country. Maybe there are still some markets which are holding up. I'm in Silicon Valley, which is a very, very strong real estate market. But most of the markets, if you look at it, that's where it is. But once the inventory going up is actually a good thing, is because at the end of last year, we were short about 5 million homes compared to where the demand was. So more homes being on the market is a good sign for housing, because once people kind of get a little bit more comfortable with where the interest rate is, this will be a more balanced market where there will be more homes to offer, but you won't have to go crazy in terms of offering $100,000, $200,000 over asking. You might be able to get some concession from the seller, but also it'll give you an opportunity to buy homes which practically you had no opportunity in the last 2 years. I mean, the homes were, when there were 100 buyers, there were like 10 homes. So more of a stability and more of an equilibrium between buying and selling will probably be a good thing for the housing market.
Right. So we've seen the activity in the mortgage market really crater here, and we're waiting to find a level. But we haven't seen as much movement yet in the prices of real estate. Some. What do you think will happen there in the near term? And are there regional differences? Would some of the big cities do worse than the suburbs, or what?
Yeah, so it does, but also understand that the problem with the real estate prices being available is usually you have a lag of about 2 months. I'm signing purchase contract now. This will close in 45 days. By the time that gets reported to you and I, you are 60 days out. So what you're seeing today is what probably happened in March and April. And that's why the home prices still seem to be significantly rising. When you start tracking the current state of real estate market, meaning that you see, I think Redfin just reported that almost 20% of people who went into contract canceled the contract and decided not to move forward with it. In certain cases, that's what shows you is that the people are not as aggressive into buying homes as they were, or the homes are sitting much longer than what they were. That tells you where the market is, or the fact that people are able, and there are more homes which are doing price reductions now than they were doing 8 weeks back. So we don't see those on home price index yet. We'll probably see that 2 to 3 months down the road. But that's where the market is. And that's why I was saying is that we were in a very, very crazy market. And it was understood that you cannot sustain a market like that, whether it's with any asset class, whether you're looking at cryptos or bonds or stock market or real estate in this case, you cannot sustain a market like that forever. So it was bound to happen. The good news is that we still have a huge amount of demand, and there is still enough housing shortage when it comes to construction and how much we are constructing versus how much the demand is. So we do not expect any major crash like we did between 2008 to 2010, 11. But we definitely see cooling off of real estate. We definitely see that in certain markets where there is less of a job opportunity, you will see home prices maybe going down double digit. But in markets like, say, the Silicon Valleys and the Seattles and the Charlottes and so markets which are strong in job creation will probably only see a single digit slowdown, maybe even the low single digits. Really depends on the market.
Interesting. So one man's crisis is another man's opportunity. So while we hear loud and clear the crisis, where would be the opportunities, Shashank?
The opportunities lie in, so you have to be more careful if you're on the, say if you're an investor trying to look for opportunities. There will be multiple opportunities created over next 6 to 12 months within the real estate space. People who bought during 2009 and 10 came out huge winners when the market turned around in 12 and 13 and 14 and everything. So if you have cash, if you're able to manage your finances where you're able to finance some of these things, the next 12 months is going to present some really good opportunities, especially during fall and winters when, even cyclically speaking, the real estate market does cool down even otherwise. So it's like it's a double whammy from on a good side, so to say, is to say that the market's slowing down already. You get into the late fall, early winters or late winters, and those 3-4 months could present a good opportunity because from a fundamental perspective, there's nothing wrong with the real estate market. The employment rate remains to be at the lowest level in several decades. Just the June employment report came out super strong at still adding over 300,000 jobs. So overall, at an economic level, there's not a huge amount of concern. Even if you get into recession for a couple of quarters, I don't see we are looking at a long-term home value decline. But in a short term, it could present really good opportunities. There could be certain neighborhoods, there could be certain homes if you're looking hard enough to be able to get a good bargain, both for homeowners and for investors. But don't wait too long, is because I don't expect this to stay like the way we did in 2008, where it was probably a 3 or 4 years kind of a thing. Here it could be a few months kind of a thing.
Okay. So what would we counsel a new home buyer to do here? Someone who really is getting married this summer, would like to buy a new home, what do they do?
Yeah. So when you're buying for more from a family emotional kind of a reason, timing the market is kind of a myth. It's really impossible. When the COVID started, most people held off on home buying, thinking that because everybody has started predicting that now if you can't show homes, everything is in a lockdown, real estate will take the first and the hardest beating of them all. And we all know how that prediction turned out. So when people are buying because their family needs to buy a home, because they are getting married or they have kids, so their kids need to go to different school, then you're looking at a much longer term horizon, right? You're thinking 7 years, 10 years kind of a time period. In that case, practically every market will give you a positive ROI during that time period. So, I mean, if you look at it historically in the last 50 years when I've tracked it, there has been only one housing crash, that is of 2008, 2010. Other than that, the real estate prices haven't really gone down in double digits really in any year. And we are talking when the rates were 18% during the early 1980s. So this is a very, very strong, fundamentally speaking, market. And so from that perspective, if you're getting married or if you're having kids or you're buying for that reason, there's no reason for you to time the market, so to say, because even if you end up with 5.5%, 6% rate, I mean, understand that mortgage rates move in a cyclical basis, and the US mortgage markets make refinancing very, very easy as long as you qualify. So your rates could be short term because you could get a lower rate by refinancing sometime down the road. But the house that you're buying right now, that's a long term. And if you look at 7-10 years market trends in literally any market within the US, you will see there is a very strong positive return on investment on when you invest in real estate.
Nice. So there's still opportunities. And if you, the old story of Rip Van Winkle, if you wake up 20 years from now and you're up big, and you didn't know it down a little bit before it went up.
Exactly. That's what I was saying. Is that when you're living in the house, I mean, somebody told me the other day, did you see your house is worth so much? I said, I'm not selling it. So it doesn't matter how much it is. And I'm sure tomorrow it will probably not be that much. But then, I mean, if 10 years later I want to sell it, that's when I want to know where the house value is.
Yeah. And we talk about this on the 4-Star main market commentary podcast that, the stock market's going down now too. And we don't know where that's going. It could have already bottomed it, or it could bottom later. We don't know, and we shouldn't live our life that we're so concerned, where we're stressed out to the day as to every little move and every little burp and giggle downward.
Absolutely, yeah.
So the message is: if you need a house, buy a house.
Yeah, exactly. You need a house, you buy a house. When you're investing in a house, you can wait a couple of months, you can look for good deals and you will eventually get one. But yeah, if you're buying to live in a house, I've always been of the opinion is that even if whether you bought it in 2007, just 6 months before the crash, or say you bought it 3 months like earlier this year when we probably saw the highest median price that we will see in the next 12 to 18 months, irrespective of when you bought, if you're buying at least for 5 to 7 years, you will most likely not be disappointed with the return on investment that you will get on that asset class.
Absolutely. No, I firmly agree. Well, great. Well, this has been a really fun discussion. And, this interview will be seen by at least a few thousand people near term and more later. So is there any other message that you'd like to send the investing public about the mortgage industry, or just your personal story, or anything you'd like to say? Because everyone's listening. You're in the auditorium.
No, I think I've talked about everything, both personally and from an industry perspective. But really, I mean, I think that's, Brian, you and I have been talking about the same thing, is investing is more a discipline and a habit, whether you're doing it as an investor within the real estate space or even as a home buyer who wants to live in the space, is that you don't try to look at these are long-term investments. These are not the asset class. These are not hopefully you're not buying Bitcoin today and selling tomorrow kind of a thing. Right. If this is the kind of asset class you want to invest in, US presents a very strong micro and macroeconomic factors over a long period of time. I mean, every country goes through its recessions and sometimes here and there. I mean, but we will most likely not see the kind of 2008 in our generation again. Of course, it's difficult to predict. But given all of that, it's a very, very strong asset class to be investing in if you look at it historically. And so that's what my recommendation will be, is that don't let, say, a few basis points in rate impact you in any way. If you want to invest in it, then 5 years later, hopefully you will come back to this interview and say, thank you, Shashank, that you said so, is because chances are you would have made a pretty decent chunk of money on that investment.
Yes. So keep your head about you and move forward. Proceed with caution. All right.
Exactly.
Excellent. Well, this has been great. Thanks for being with us. And I just want to thank you on behalf of all our listeners and our great 4-star team here in the headquarters city in Chicago and around the country. Again, thank you very much for joining us. And hopefully we can hear more from you, and we'll see a new book soon, I understand, right?
Yes, hopefully.
Excellent. We'll look for that. And thanks again for being with us. Thanks, everybody. Don't forget to give us a 5 out of 5 ranking for this great interview. And we will hopefully check in with you on the Shashank Redemption podcast later on. Is that
cool? Yeah. That is correct. So check me out at shashankredemption.com or the podcast on Spotify or Apple. So thank you again, Brian, for hosting.
Thank you. Thanks for being with us. Thanks, everybody. And we'll be back with another really great interview just like this. Thanks, everybody.